My name is Steven Grabowski. I work at StoneX. I'm the co-head of capital introduction with my colleague is here as well. So our clients use us for outsourced trading and also for prime brokerage. And then our job is to talk to allocators and try to find connection between our clients and those allocators. So my background before joining StoneX, I've been an investment consultant for about 14 years. So my natural group is with, talk to endowments, foundations, family offices. So I tend to think like that in terms of how portfolios are put together. And one of the things when we look at events like this, and thank you, Megan, for having us, is really just trying to connect some groups together. A lot of times we're talking to managers, emerging managers, and we're also talking to service providers, and we're also speaking with allocators. And because we spend a lot of time working with allocators and asking them what they're looking for, thinking about how they view portfolios, we get some really great insights from them. And I try to share that with my manager clients who are wondering, hey, I've had a great year, why am I not seeing inflows? Or am I big enough? Or what do the allocators really want to see that I'm not, the ones that are, frustrated with their growth in AUM. So what I try to do is kind of bring folks together. And so I feel like having that background, I have kind of a unique vantage point, looking at things from inside of the table as an allocator, but also doing what I do now. And so when I was thinking about content for this evening's event, I've come to know the folks, my guests, and they also have a very unique vantage point from how they look at hedge fund investing in this industry and how they work with clients. So I'm joined with Gwyn and Joe, and they're going to talk to you about what they do with their role at PivotalPath, what they're seeing on behalf of their clients. I would probably be not do as well of a job to explain your backgrounds and what you all do, so maybe I should let you introduce yourselves, so that'd be more helpful.
Great, thank you. My name is Gwyn Roberts. I'm head of research at PivotalPath, and my background is I've been working in the hedge fund information and data space for longer than I care to remember, certainly a long time before the mix got good. At PivotalPath, we do a series of things. Our core clients are allocators. We work with almost 120 allocators today, a very broad range. It ranges from larger single-family offices all the way up to sovereign wealth funds. And what we do for our clients is we help them with their hedge fund investments, we help them with their hedge fund research, and ultimately we help them to monitor their portfolio of hedge funds. So today, if I look at our client base, the way it breaks down, it's roughly sort of 35% single-family offices, a good number of endowments and foundations, pension funds, sovereign wealth funds, as I mentioned, funds of hedge funds and private banks as well. And our services, they split in many different directions, but ultimately we're there to help them with IDD. We don't take discretion. We get them to the point where they can go off and make an informed, hopefully correct decision. We gave up doing ODD a few years ago, so basically they will take that away from us. They'll take ODD, they may use a third party, and then ultimately it spins back to us once they make the investment. And we're there to help them monitor that fund. We do that by our data, our analytics, we built out our own platform. And then people like me and Joe, we also speak to the underlying funds on behalf of the client. We're there to not so much really underwrite the investment, we're there to help them understand changes at that particular business. Has somebody left? Has somebody joined? Is there a new opportunity set that they're seeing? Or even explain a period of poor performance or even a period of excellent performance. So that's essentially what we do. And very pleased to be here tonight. Thank you to StoneX and to the Alternative Investment Network, and also City for having me.
Cool. Hi everyone, my name is Joe Bistany. I work on the research team at PivotalPath. Prior to PivotalPath, I was on a sales desk at Morgan Stanley. I've been with the firm for about 4 years, so a lot of my job is speaking to the underlying funds and figuring out what they're doing in their investments and mapping that out to the wider hedge fund industry. That's valuable to our clients because they're investing in hedge funds and understanding where each one sits in relation to another is sort of hard information to get, especially when you're looking in great detail at individual hedge funds. So on a given day, I'm speaking to anywhere from 4 to 5 hedge funds. That ranges anywhere from distressed credit type strategies to very liquid U.S. equity strategies. Gwyn covered most of what we do here at PivotalPath, but that's sort of how I fit it.
So on a day-to-day basis for your clients, are they reaching out to you? Is it somebody that they've So you're on a retainer over the course of the years, you're there serving in a consulting role, and they're coming to you with problems, and is there discretion that you take, or is it that you steer away from taking discretion? Can you just give us a little bit more color on,
Sure.
on how you interact with your clients?
Yeah, so I'll start, and feel free. We are contracted on a retainer basis, so they pay anywhere from a flat fee that's decided at the beginning of our relationship with an underlying investor. And the types of investors we work with are pretty broad, so we'll work with like single-family offices that may be a couple $100 million, all the way to sovereign wealth funds that may be tens and tens of billions, and their needs and differences between each of those types of clients is quite different, especially when they're investing in hedge funds at scale or in a very concentrated manner. So they're oftentimes reaching out to us for services in sourcing managers and high-level investment due diligence on what each of those managers are doing. So that gives them and expedites their research process to when it comes time to make an investment, they have all the high-level information they need to before they spend weeks and months with an individual manager and they allocate. Gwyn, anything else?
Yeah, I mean, the rationale for each investor making a decision is different. I mean, we work with some very large investors. They're much more driven by process, so they're looking to fill a particular niche within a credit book or an equity book. And then we have others who are just more opportunistic. They're just looking for good ideas. So the way our process works, it's pretty multifaceted. I mean, they may come to us with the beginning of an idea. It could be, last year we did quite a lot on healthcare towards the end of the year. There was that whole run, as many of you will remember. And we had a host of our family office clients just wanting to know more about the healthcare space, who was good, who had sustained performance, who's generating real alpha as well. And so that was a much broader, wider suite of the information that we have and the conversations that me and Joe and other members of the team have as well. And then they have a large fund of hedge fund that comes to you because they have a particular need at a particular point in time for a credit mandate. And that would be a very different approach. We would take their criteria, we'd do a sort of quantitative screen, that would throw up a certain universe, and then we'd go off and have conversations with those funds on their behalf as well. And as Joe said, at some point after that high-level research, we make the decision, or the client makes the decision, we just hand it over to the client. It doesn't mean we're not part of the process. Our journey is sort of reaches a semi-conclusion at that point. Once the client goes off and does their own work, or maybe uses a third-party consultant to do more OBD, then he comes back to us again. We help them understand the changes over time as well. I think one of the important things that we do as a business is, because we handle a lot of data and we built our own analytics, just because you invest in a fund now, it doesn't mean that fund's profile doesn't shift over time. Sometimes their net exposure changes. Do they always tell their clients? No, they don't. Sometimes the opportunity set shifts as well. So we're there to keep an eye on that. And we also help to benchmark as well. I mean, ultimately, a lot of it's boils down to performance. So we keep a close eye on performance, not just relative to that manager, but how that manager sits within his peer group as well. And that's one of the key areas that both me and Joe work on.
Gwyn, you touched on this a bit, but I feel like maybe we can tease this out a bit more. Across all of your clients, and people say like, oh, okay, if they have a total portfolio, right, they're invested for the long term, usually for the standard, like an institutional allocator. Are they thinking of hedge funds as an asset class? Are they thinking hedge funds as a title? Like, are hedge funds being used alongside, say, their growth book or their global equity book or their credit exposure or their defense? I mean, what do you see from the different allocators that you work with, your clients, how they view hedge funds?
Yeah, I mean, increasingly we are seeing that total portfolio approach. So hedge funds are being used to fill a particular need within a credit bucket or an equity bucket. Although we still have clients who see it as a particular niche. I mean, hedge funds are not an asset class, it's a very cool church. But certain clients, some of our family office clients still have a particular hedge fund bucket, and they have a particular exposure profile they want to fill, or they have a particular AUM in mind, and they're looking to sort of fill those searches. But I would say the majority of our clients, particularly as we've grown as a business, I mean, our clients have become more sophisticated, certainly larger clients. We work with some very good pension funds. They're using hedge funds across the portfolio these days.
And shifting gears a little bit, say over the past 12 months, I chatting just before this to a couple of folks saying, like, where are hedge funds right now? Like, Is there increased interest, decreased interest? Are they the hot topic of conversation? What have you seen in terms of activity, whether that means bringing new clients on board or increased activity from your existing clients? But what would you say overall is kind of the current state of the union for hedge funds, and also maybe kind of going into towards the outlook?
I can start and hand over to Joe. Currently, it's pretty good. I mean, I would say that we've lived in this sort of status where there's been a high level of interest for the last 2 years, 2.5 years, but the velocity's been quite slow. I would say we're now seeing the velocity of new allocations reach that high interest level. And I think that's happening for a couple of reasons. One, a lot of clients were sort of pursuing a wait-and-see policy. Hedge funds have been very good 3 years across multiple strategies and look at performance. Some of them are still very much tied up. They're waiting for distributions from private markets funds. That's still happening. So I don't think we've seen the full extent of the activity or the intended activity yet. I think it will actually get better. And then some of them last year, particularly the endowments and foundations, they were tied up with sort of tax concerns. And I think they were worried that the government would pull the rug from under their feet because of some new regulation as well. So that was holding back actual cash allocations, but the interest was there. We could see that interest growing. I think from the beginning of this year, and this sort of broadly aligns with what the other consultants tell us, what the clients tell us, we're seeing more flows into the space as well. And I mean, Joe, I think that's fair.
Yeah, absolutely. Hedge funds are definitely way more popular now than they were 5 years ago. That's for a variety of reasons. Gwyn touched on it a little bit with the move from private markets back into public markets. It felt like for a long time there was a premium on illiquidity when, in traditional finance, like there should be a premium on liquidity, which I think investors are coming back to and realizing that that is something that's missing in their portfolio. Additionally, like I'm sure you guys all see the same headlines that I see, that there's a lot going on in markets, a lot of dispersion and volatility, which all buoys the chance for a portfolio manager that is very astute in a specific strategy to generate alpha and returns eventually. So yeah, everything that could be pointing green for hedge fund inflows is happening right now.
And would you say that's across a wide range of strategies? And I know you can speak on behalf of your client base, which is very wide, but would you say, like, is there an interest in, bringing down beta in the portfolio? Is there an interest in gaining more credit exposure, but outside of private credit? Like, what are some of maybe some of the case studies or tales that you've heard from your clients about what they're looking to identify and why?
Yeah, I mean, it's across the map. The point about bringing down beta is true. Maybe bringing down correlations as well. I think there's been a concern from some of our clients that they take a look at equities, but highly correlated to the US, highly correlated to the S&P, so they're looking for something that's not quite a risk mitigation strategy, but something that's generally uncorrelated, generating real alpha as well, and that's played very well to the strengths of all of them, certainly some of the hedge funds that we cover as well. And then you're looking at clients who are looking for more sort of risk mitigation approach, and that plays well for strategies like global macro as well. And I can give you my take on it, and Joe will also have a take as well in terms of some of the highlights of the last 6 months in terms of actual allocations that clients have made and the strategies they've gone into, and also the rationale behind those investments. So, we've had a lot of activity around discretionary global macro, generally, not always actually, but generally correlated to equity markets. A lot of dispersion globally in the world, dispersion around rates, FX. If you're on the right side of those trades, it plays very well. So a lot of our clients have been interested in those strategies, and we've seen some allocations to not only the sort of top tier within the space, but the tier 1, the well-known names, but also some of the newer launches as well, which I know will be of interest to people in the room here. We see a lot of interest, ongoing interest in equities. I think this is interesting. Maybe this sort of informs that type of portfolio approach you're talking about. Is the interest in equity strategies is almost a barbell. At one end, you've got high level of interest in equity market neutral and funds that have a low net strategy. The stuff in the middle, we sometimes call it the messy middle, variable net managers. A little bit less interest there at the moment. But you go to the sort of far right or far left, depending on how you look at the space. We're seeing a lot of interest in almost long-only style hedge fund strategies, active extension, those types of strategies, and it's those strategies that are plugging into their sort of equity book. And I think they're almost expecting that they don't want to be index hunters anymore. They think something's going to happen to the markets, and they want a combination of good stock pickers and also managers who can go short when they need to go short as well.
Yeah, the only other thing that I would add to that is that the types of PMs that our clients are looking for right now is ones that have the ability to adapt and adapt quick. As I mentioned in my previous remarks, the market and the world is changing really fast. So managers who have a rigid focus on a certain subsector or a sector of the market, but have the mental flexibility to switch in between macro regimes is really important to people right now. So that's sort of an archetype of type of manager that within those buckets that Gwyn just mentioned that I think is really important right now.
Yeah, and from the allocators with whom I speak, I would echo what you just said, the both of you just said. I do think that, beta won for so long, and what do you call them, FANG M's or Magnificent, you keep going through these, but what I tend to find from large institutional allocators is that they're still looking, they consider it growth, right? They have different roles to play. So you can call them hedge fund, you can call it your equity fund, but you have to have so much offense in order to meet the 5% regular spend plus inflation. That's a lot of the goals for those taxable institutions or non-taxable institutions who need to meet that spending. So they're looking to play enough offense, but what we tend to hear from some of those large institutional allocators is you find us good people who can earn a competitive absolute return. So we don't want stuff that's too defensive that competes with bonds, something too boring. We need it to be in the high single digits into the double digits, but then also that are doing it in different ways than the rest of the market, right? So they can get beta for cheap. They also have other managers in their portfolios, so they tend to gravitate towards the high conviction managers that tend to have greater concentration in order that, if this is your area of expertise and you can find a way to add alpha over time, we'll put you alongside a bunch of other managers who are doing it in different areas so that when something's work, right, we'll trim, we'll reallocate, or that's where we'll take our spending from. But they tend to look at managers, I would say, who are growth positioned for the most part because they're trying to overall help out that goal across the portfolio. And then I think on the flip side of that is true diversification where they're still expecting an absolute return, but they want it to really be a lot different, right? So they'll want lower correlation to the markets from their hedge fund managers, whether they're getting it through credit or through macro or for different more esoteric strategies because they know how to get some of the whether it's cheaper or whether it's more trusted returns, and they need to have something else in the portfolio zigging while the other stuff is zagging. So I feel like there's quite a mix and quite a mix of interest. Sure.
Yeah, question. Thank you both. Thank all three of you. I think both speakers noted that in recent times the appetite for hedge funds seems to have returned. My question is, to what extent is there interest in startup, small, and emerging managers? Because I think we generally think that they are some of the greatest generators of alpha, but they do come at risk. And I'm just curious, your clientele, do they have an appetite for the startups, the smaller managers? And if so, what type of diligence, how is diligence different on those managers as opposed to diligence on larger, more established ones?
I can have a go at that. I mean, I'll start with the diligence first. A lot of it boils down to pedigree. Where has that manager come from? So a manager without pedigree, of course, they're going to find it much harder.
Could you speak a little louder, please?
Yeah, sorry.
Thank you.
Talking about diligence, a lot of it boils down to pedigree. So a manager who's spun out a multi-strat, maybe a new fund, but they have that pedigree, they have that career history, they're going to stand a higher chance of magnetizing capital from clients like ours who are more institutional in their makeup. A manager who has come out of the bank and trading desk, maybe, but managers who come from nowhere, who haven't got those bona fides, who haven't got that pedigree or that history, they're going to find it a lot harder. In terms of the appetite for newer managers, there's a couple of factors that are contributing to that being pretty high at the moment, and I'll try and explain why. So access points for hedge funds. I mean, 5-10 years ago, people were still primarily accessing through commingled funds. And so if you're an institutional allocator, it's very hard to be the largest investor in a commingled product. I mean, often that would stymie any early interest. You may love the manager, you may really like the process, you may think they're a good bet. But the argument normally was, well, I like you, but I'm wait until you get to $1 billion, we wait 5 years, and at that stage, everybody's moved on. It's really difficult to keep that relationship going. Now, with people using separately managed accounts, where you can control the investment, you see through the investment, we're finding there's a much bigger appetite, certainly from our larger clients, to go in at an earlier stage as well. So that's one key advantage of using that type of model. It also explains why we're seeing more allocations into early stage managers as well. On the basis of the pedigrees there, I mean, those two things sort of marry pretty well together. The other thing is, you mentioned alpha production. Now, we look at alpha very carefully, and alpha is not the preserve of smaller managers, but you're right, the first 2 or 3 years of a manager's life, often they are able to outperform, they are able to generate real alpha as well. And so a lot of our larger clients who use SMAs are now thinking, or they've already started to set up emerging manager programs. And so we're working with a pension fund client at the moment, very large pension fund client. They haven't invested in new managers in the past. They are starting the emerging manager program with a particular bias. They are looking for multi-strat spin-outs. Now, technically those managers have already emerged. They've got a very good pedigree. But what they're doing is they're looking to see which talent is leading a Millennium or a Citadel or a 72. They're looking for managers who can adapt beyond Millennium style of risk management, maybe run at a slightly higher net as well, so not completely market neutral, but have highly concentrated portfolios, have really interesting thematic tilts that can manage risk really well, and they're looking to see at an early stage. So I would say the appetite is probably more than it was 5 years ago. We are seeing a slight shift there.
Yeah, I guess what I would add is that we definitely have clients that are interested in emerging managers, and those clients break down to a few different groups. Gwyn mentioned one, which is a very large institution like a pension or a sovereign. Specifically, Canadian pensions have sort of emerging manager type programs where they'll come in with a couple $100 million ticket and anchor a fund without any sort of considering economics. That's definitely one group of emerging manager type of investor. The other is the one where it's their business to invest in emerging managers, where they're trying to have a seed in an individual fund or have a revenue share at the top line with the fund. Those are two different types of investors in an emerging manager, and the types of PMs that will take a deal from the business-like emerging manager are different than the PMs that are aiming for an anchor from a pension or something like that. So to keep that in mind, what I would say is that in the talent pool of emerging managers, what we're finding is that, as Gwyn said, like a lot of the emerging PMs are sat within these multi-strategy funds, and they're all trained the exact same way. They all did 2 years banking, maybe 2 years private equity, and then they joined a multi-strategy, something like that. Those people think very similarly because they all have the same experiences. So finding emerging managers that are maybe long biased or have longer duration or trade differently than the people that are trading inside of multi-strategy funds is a lot harder to find now than it was 10, 15, 20 years ago, because all of the young people who want to trade and want to be PMs are going to these places and getting paid a ton of money. So yeah, I'm even hearing this from PMs who are trying to hire junior folks, that they are no longer hiring from multi-strategy type of funds because they're all thinking the exact same way, and when everybody in the market's thinking the same way, all of a sudden alpha goes away. So just bearing that in mind, that's sort of how I see the emerging manager type of situation.
Yeah, and depending on how you define emerging manager, I feel like there's day one investors, right? And that's a very high bar. I think a lot of times when you might have a manager who's rotating out of a really strong hedge fund or a large bank, and they've been running money, and they say, I've done this before, I'm good at it. Like, why am I not seeing flows, or why is my launch going to come in smaller than what I expected? I would say there are not a lot of investors who are willing to become day one investors to some group that they don't know, right? So it's very easy if they've rotated out of a fund that they've been invested with a while. They might even be the analyst with whom they've spoken to on a quarterly plus basis, and they've known them forever. They like how that he or she thinks, and it's more of a natural because they know that background. In order to get somebody who who has no history of relationship with a new manager, that's a higher bar. And I just have a lot of allocators that say, they sound great, they seem smart, like I like the strategy, that's what we're looking for. I'm going to wait till up and running, maybe take 6 months or so, just making sure that the returns and their strategy is coming in and they're doing what they're saying they're going to do. They'll say like founders fees, like that break in the founder fee share class is not enough for me to be a day one investor, but I'm happy to be an early investor. So they do look at emerging managers with in a positive light because these people are hungry. This is maybe a new idea. They're building out something. They obviously want to grow, and so they're intrigued and enticed by these emerging managers. Day one, I think, is a very different animal. And so we're always telling them, sure.
Along the same lines, is there a minimum size that you guys look at before it hits your radar?
No, I mean, we're pretty democratic in size. I mean, I suppose our cut-off is we're looking for funds that have an institutional pedigree. So we typically wouldn't cover one person with a Bloomberg terminal. It's difficult for us. Now, we might do. They break through. They suddenly hire a COO. They build an infrastructure around them. But we would look at a small manager who's left either a big single strategy firm or has worked at a big bank and has a really good reputation as an analyst, or has left a multi-strat as well. So we definitely will look at smaller managers, and we will look at new launches all the time. And to be honest, to your point, we're now compelled to by our clients. I mean, I think 2 years ago, we probably didn't have the same awareness as we're launching that we do today. I mean, it's a very important component of what we do and how we look at the space.
Can I ask a question? Actually, you stole my question I had. Do we have an assessment model that quantifies, it's very important to quantify how we assess the manager, so you can score a number, right, to that particular manager. Because on one side, you can look at what you did was wrong, and the clients have it understand, hey, you got 95 out of 100, or 25 out of 100. And the reason I'm saying this is because when we were, I was with US Trust, 2005, we launched 5, 6 or 7 fund of funds. We did have a model like that to how we identify which underlying fund we invested in. So do you have something like that? And then the second question I have is, do you have a lot of separately managed accounts and they're not even a fund? You may have a good strategy. Do you have them how to become a fund so investors can invest in that? I've never seen anybody doing that. There's a great business model if you come up with a strategy that working for multiple clients, SMEs, and then converting somehow, not for them, but because the strategy works, help them build a fund. So like 2 separate questions. I don't know who wants to take the first and the second.
I'll take the first.
You take the first, yeah.
Yeah, we definitely look quantitatively at a fund. A majority of what we're doing quantitatively comes from a returns basis. So given where we're situated in the market, we're providing breadth to our clients. We're providing understanding of where one fund sits in relation to another fund in the same strategy. So the way that we do that quantitatively is look at their returns and run all of their metrics, i.e. that you would see at any allocator, like beta alpha correlation, correlation to other funds within their portfolio, or correlation to whatever given benchmark. We also have our own indices, so PivotalPath has hedge fund indices that track individual strategies, so we can look at correlation to those internally. And then in terms of like a score, we equal weight different metrics internally that come up with a score. We have a gentleman in-house that is very more quantitative.
So multi-strategy, it gets very complicated, right? If you have multiple strategies, you can get fun. So it's very difficult to benchmark.
It is. It's very difficult once like you're talking like a multi-strategy type firm. It's very difficult to underwrite those type of people because they have so much going on. And what I would offer you in underwriting a multi-strategy type fund is that how I think about it at least is like a business. Like those types of places are a business instead of an individual PM. It's like how well are they running their business from the top down can in some ways dictate the type of returns that you're going to get. So maybe in that scenario we would overweight the qualitative portion of our diligence rather than the quantitative.
Yeah, and in terms of the SMA question, we are seeing that. And it's interesting, we're seeing it more than ever before, where a manager may fully intend to launch a commingled vehicle, but because they're getting their first investment, maybe from another multi-strat via an SMA, and then their second investment is via an SMA, possibly their third investment, they never actually get around to launching the commingled. So they can run a series of SMAs for a number of years before they suddenly decide, well, we should launch a Cayman vehicle, maybe it's for smaller tickets. And so that track of starting a business and launching a commingled and then maybe launching on some SMAs, for some strategies and some managers, it's definitely reversed. So we see a lot of our clients, well, not all, but a lot, almost verging on using SMAs exclusively these days to make investments. And that's definitely changing the complexion of how managers want to respond to SMAs. You know, in the past, 50% were likely to say no. We don't want somebody stood behind us of having absolute transparency. So the majority now think, yeah, we will do this, and you know, it's a good way to start a business. I think the downside of just relying on SMAs is that money can leave you pretty quickly. And so if you have an SMA and it has a ticket from Millennium of $1 billion, and then you have a commingled with $25 million in, if Millennium decide that you've breached their risk requirements or they just want to move on, they can pull that money and you'd be basically using the management fee to hire expensive analysts, and the commingled isn't going to cut it. So there's a danger there as well. But we do see that a lot. We see SMAs that are launched and then pivot and turn them into commingled funds or add on a commingled fund as well.
I think in those early years, it's a lot of managers trying to figure out how they become themselves sustainable, right? I mean, there's one thing building a track record, but if you're launching at $10 million and you're saying no to SMAs, you're going to have to spend some time putting up good numbers before you attract interest of other players. And those other players, if you launch too small, those other players can only go so large themselves, right?
The reason I'm seeing a situation with the crypto SMA, they are difficulty launching a fund because the SMA, the minimums are much higher, and for funds, minimums could be a little bit lower, and it's the same exposure. And that could probably change over time. But you're absolutely right. Typically, that's the trend people want to do, like you mentioned, right? Go more SMA from, so have more control. But I think certain crypto, actually I ranked a few of them recently, they're using a lot of market neutral strategies, and they've identified some amazing fund managers. But unfortunately, they don't have the fund and they still work in SMA, and unfortunately investors with the small ticket size are not getting exposure to those kind of investments. And that might change in a couple of years. But
yeah, I think from what I've seen, the managers themselves are sort of open for business, right? So they decide whether it makes sense for them to deal with having multiple SMAs, and so obviously they'll put minimums of a significant number in order to make sense for them, make it worth the problem. We were with one of our clients earlier today, the long-short manager. Unless that number is very large, they've been at it for about 3 years. They've been growing assets, been doing very, very well, and that's starting to help them growing assets at the end of this past calendar year and into this year. That they're seeing a lot of interest and investment, which is good because they've been doing their part about putting up great numbers and sticking to their knitting since they started. But they're pretty much like, we're done with SMAs. Like they've reached that critical mass where they think that what they'd like to do is treat all the investors the same. They'd like to get full freight on the fees. They'd like everybody to be in the fund. They don't have to spend that much time away from the investment side of the business. They're in a good position to be able to say that, to be picky with investors. Where we've worked with other clients that say, like, I'll never turn down any SMA if it's above 50 or 100 million, as their total firm AUM is still sub $1 billion, sub 500 million. That's still, helping them reach their ultimate goals. Question?
You said they stuck to their knitting, and Joe, you said that people want somebody who can move with flexibility and shift their focus. They used to call that style drift.
Yeah.
Is that a good thing now, or?
No, my point was that they have flexible thinking in their regime analysis. Like they stick to the same sector, the same strategy, but their ability to adapt to different market environments is very high. Meaning that they have the ability to understand what's happening in the market and then implement in the same style and the same strategy different exposures. That's sort of what I was thinking. Style shift is definitely not in fashion still.
Yeah, I think when I made the point earlier about the allocator saying, we're glad that we met you, we would like to pursue an investment with you, but we're hiring you to do this. Like we have right next to you, right? If it's somebody who's high growth or tech, like, don't worry, we don't shift because we have somebody else in that bucket. So I would think that's one of the things that might be tough for earlier stage managers is whether their style's not terribly in favor, and so they want to have time to grow and stay alive in order to generate assets coming in. That's one of the temptations, and I think that's a non-starter for a lot of institutional allocators. They go back and look at your first 18 months of being in business, and they notice shifting trends. They don't know what they're buying, and so they'll stay away.
I mean, it's one of the reasons why we exist. We're looking, and Joe mentioned the quantitative process and the scorecard that we have. We're able to do that pretty well. We can look at the funds and isolate that fund within the context of its peer group and see exactly why it's different and why it's similar. Within the context of something like style drift, we look at that for our clients. I mean, they've invested in a fund for a particular reason, and it could be that they want just TMT with low net. We can carefully monitor that net exposure because over time it may creep up, and the manager might not even realise it as well. And most of the time they do, but sometimes they just don't. Our client might not realise it, but we will look at that on behalf of clients as well. And so we're very hawkish around that type of change.
Other questions? Well, we're still short of time. We're going to open it up, and so if there are no questions, we can adjourn early.
I have another
Sure,
question.
yeah.
So I heard early on you mentioned, maybe you didn't phrase it exactly this way, but there's the investment due diligence piece, and then there's the business due diligence piece. How would you weight the two? Or does it vary by situation? How important is business due diligence, operational due diligence, when you look at a manager?
It's really important. I will caveat that by saying we don't do ODD, we help with IDD. If you need to weight it, this is the way that we look at it. Once we finish any sort of project for a client, any piece of research, once they're happy with the IDD and they're ready to make a decision, their mind is made up. It's down to the ODD, if the manager fails ODD, to basically dissuade the client from investing. I mean, if the ODD checks out, then chances are they will invest. So in some ways, in terms of the actual decision-making process, the IDD is the most important aspect. In terms of underwriting that decision, the ODD is important. It's just as important as well. But if the ODD passes muster, then you generally, unless it's something strange over the fees, you're going to invest.
Okay, and so I think I even heard you say this, Gwyn, that when there are problems, it may have to do with how they operate the business. So smaller funds have fewer people generally, right? And they're unable to specialize the way larger funds are. You mentioned big names, Point72, Millennium. I mean, these are big companies, right? And they have the ability to specialize. The smaller companies are more reliant on a network of service providers. Is that the case?
Yeah, I think most of our clients, we certainly do this as well. There's a certain amount of proportionality. You wouldn't expect a startup to have a huge back office. You wouldn't expect an investment team to have 20 analysts as well. I think where it becomes a problem is if the PM is also wearing the compliance hat, it's also the IR as well. It's not so much because it's a red flag from a corruption perspective. It's more, how can this person do this efficiently or do every role efficiently as well? We do work with funds that have externalized those services, and our clients have invested in the funds that have outsourced operational providers, outsourced compliance providers. I think what they expect though is as you grow, once you hit 200 million or 500 million, you're also evolving that operational side of the business as well. If you get close to $1 billion, you're still the same firm that you were with the same number of staff that you were at 10 million or 20 million. That can cause issues.
So are you also looking at the business viability, not just the investment thesis, but the business viability of the enterprise, right? In other words, if the lead person and there usually is a lead person, right? And that person becomes the poster child, so to speak, the face, and he or she articulates the investment thesis. That person, if that person's spending too much time raising money, who's watching the shop? Who's actually making the investments, right? So when you place capital, or advise, rather, people to place capital, are you considering the business economics of the enterprise? How long to break even?
Yeah, I mean, we will look at viability. We'll look at it in multiple different ways, but ultimately, because of the role that we perform, this is the investment due diligence. What we're looking at is, does the strategy make sense for the client? Is the performance there? Is the alpha there as well? In terms of the long-term viability of the fund, we would generally hand that off to somebody else, but it is something we're aware of. Of course, we are. It's also something our clients look carefully at as well. The point you made about the founder who is the star PM, but also raising the assets, in some ways it's perfect. In some aspects it's fine. I mean, our clients would feel pretty misled if they didn't have a meeting with the PM before they made an investment decision. Now, how the PM manages their time and the trust that they show in the IR team, really the IR team is the first meeting, maybe the second meeting, and the PM is rolled on, and that's an efficient use of their time as well. They're in every meeting, and maybe it causes some concern, but ultimately our clients are looking at the investment quality, the process quality, and if that's still there, chances are they will go forward, they will make an investment.
Thank you.
Yeah, we also deal with a lot of emerging managers. Just curious what your opinion is. A lot of times you see managers starting out like this two-people team. You got the decision maker, the PM, the trader, you call it, and then a guy who's kind of running operations, sort of taking care of the day-to-day. What should be, aside from outsourcing, what should be the next internal hire, in your opinion?
Happy to take that. I think the next internal hire should be on the investment team, an analyst. It obviously depends on the strategy, depends on how lone wolf said PM is. But typically, from my perspective, if you're seeing the PM invest in the analyst, invest in the investment team, he has a long-term horizon. He wants his person early and often so that they can get used to each other. So in 5-10 years now, it'll be his, like, he can say in a pitch that this person has been here for 10 years. If you invest in the business side, the argument is that it gives more time for the PM. The PM can spend more time on investments and less time doing back office or whatever business side type stuff. There's an argument for that. My opinion is that if you hire an analyst, specifically, in my opinion, should be somebody junior, it takes a lot of good grunt work that the PM is doing by himself to think higher level and think through tough decisions more thoroughly than he would be going through a spreadsheet or inputting data or whatever it might be. With the advent of AI, I think a lot of that is being displaced, like that thesis, that train of thought that I just went through has to be in some ways rethought about how senior, how junior, because AI can do a lot of what a junior analyst is doing. But that's my opinion. Gwyn, any opinion?
Yeah, I mean, I think the quality of the investment team and also the ability for the PM to, one, make those hiring decisions, but keep an analyst for the long term, hire a second analyst. That's important because if you have a high turnover of analysts, chances are you're not really a hiring analyst or you're impossible to work for, and that could be a red flag. Joe's point about AI is interesting. We've spoken now to a number of funds, both Lee and Joe, who have launched recently, and their argument is we don't need an analyst. We have Claude doing this for us, and it's an amazing tool as well, but our clients just aren't comfortable with it at the moment. I'm sure that will change over time, and we're quite happy and quite prepared to accept that change as it comes. But at the moment, a fund that's run by one PM who tells us that they have 5 agents equaling 5 analysts, not so sure about that at the moment.
You mentioned dispersion is growing, there's more opportunity for hedge funds now in the last couple of years. Is that something you can highlight to your clients, or is that a criteria for your recommendations?
Sure, yeah, absolutely. I think that us highlighting an individual subset, like if we're seeing great dispersion within a sector and there's a reason why, it's not necessarily our job to find the reason why, but to highlight that there is dispersion somewhere and this person is taking advantage of that and this is how they're taking advantage of it. Sure, that's absolutely fair game. It's something that we do. I think that what you're seeing right now in the markets is truly one of a kind, and you'll be seeing a lot of funds succeed off of the dispersion in this market and fail, ultimately fail off the dispersion in this market.
Yeah, I agree with that. And actually talking about dispersion, we look at dispersion amongst managers as well. So not just the opportunity sets that they're trading, but I think I started the panel by mentioning that we've done a lot of work in discretionary global macro this year. And the dispersion within that space last year was huge. And often that's not just about the decisions they were making around the same trades, but also just the wide variance in what they were trading as well. We found a lot of the discretionary global macro managers last year who did very well, very biased towards equities. You had that continued bull run, and then this year it's been a slightly different story. The equity market's been quite volatile, been quite narrow, very concentrated within AI. So you're seeing the more traditional global macro managers bounce back, the ones with rates and FX and those as well. So it's a dispersion in a particular cohort is also quite interesting for us as well. It's quite telling about what we're looking at, how they think about their particular strategy, and also what assets they're trading as well.
Okay, any more questions?
Okay, on the back. You had mentioned a lot about how you help investment managers find attractive hedge funds to allocate to. Where are you seeing emerging managers in the inverse find capital to get started or grow?
SMAs is primarily what I'm seeing right now. I would say a lot of the emerging managers that are gaining traction are spinning out of multis and getting an SMA from the said multi that they just spun out of. I mentioned a little earlier, the folks that it's their business to make a deal with those emerging managers, so they're taking a rev share, or they're like haggling you on fees, or they are taking a stake in your business or something like that. That capital has always been around. I would say it's increasing over the past couple of years because of, in the 2010s-ish, a lot of that sort of seed and entry capital went to privates because that was a better business proposition for them. As hedge funds raise more and more capital and flows come back, that's swinging back slightly. And then lastly, sort of the blue chip, what every emerging manager wants is to get an emerging manager program at one of these massive pensions or sovereigns or something like that. Those are folks that are happy to seed you with $300, $400, $500 million on day one. See how you do over the next 1, 2, 3 years, and then sort of upsize you if you make it out of that 3 years unscathed. That's sort of how I see it, but a lot of the emerging capital, as I said earlier, is coming from multis.